Tyson Drake worked as a head of marketing, chief marketing at an 8-9-figure brand. Tyson Drake has worked under a VC firm for paid media and paid search marketing. And more recently, Tyson posted on Twitter a dashboard that he's been building with data scientists for over 12 years that combines all of the metrics that we've come to love and hate in e-commerce. Contribution margin, gross margin, AMR, everything is in there. But in addition to that, he's also created some visualizations that take into account things like survey results, percentage spend by channel, and he claims that it is one of the most accurate ways to present data in e-commerce from multiple sources. That could be from someone like Northbeam, it could be from the Meta platforms, it can be from Shopify, but all of it is amalgamated into this incredible dashboard that he says is the best in the biz. So in today's show, which is a 2-part show, in part 1, we discuss his background, his experience working at a VC model where they actually had 100 people on staff that they would implement into invested brands, and also his experience growing a massively successful brand and how he came to create this incredible scorecard. And then we talk about the scorecard itself, breaking it down and trying to get an understanding of how it operates, how it works. And really for me, is it too good to be true? Because it caught fire on Twitter and I just really wanted to understand, is this a golden or silver bullet to all of our DTC data decision-based making problems? So that is all to come on the e-commerce Gold podcast, brought to you by SendLane, brought to you by Rewind. Go and check them out, links in the show notes. The SendLane email marketing, SMS and reviews. Rewind, the protection suite for your store, backups, staging site and more. Welcome, Tyson, to the e-commerce Gold podcast. How are you doing today, sir?
Thanks, Finn. Appreciate you having me on.
We got an Aussie on today, folks. Usually we're blessed with the States, but today an Aussie, which is much closer to my current time zone. Whereabouts in Australia are you right now?
We're in Adelaide, South Australia. I think it's plus 10.5, 10.5.
Yeah.
I didn't even know my own time zone. Plus 10.5 is the standard of the 10. Yeah.
Well, most of the listeners of this show are American or Canadian, and we talk from time to time about other markets because they do exist, people. There are markets outside of the US. Just give us a bit of an insight into the Australian e-commerce scene. Like, what's it like down there? Let us know.
Yeah, I mean, there's some pretty big brands down here. Maybe people are familiar with the hoodie, a big oversized wearable blanket. I was the CMO of the hoodie for when I was there, and I was the head of digital as well. So that might be one of the more known ones. What else? They're based in Adelaide as well. So what else? I'm just trying to think.
Well, I know Amazon's pretty. It's either big down there or it's not big. I can't remember now off the top of my head.
It is. But we do have some of our own marketplace. Amazon entered the market maybe 5-6 years ago. Hi Smile.
Oh, you got High Smile down there? Yeah, nice.
Or Smile Direct. I mean, I'm not really super like connected with the local scene, or Smile. Yeah, I'm not really super connected with the local scene. Most of my work that I do is more internationally. Like, I've actually had more international experience. I spent some time in Berlin, worked for a venture capital firm, mostly in direct to consumer and marketplaces. I now run my own fractional CMO consultancy. All my clients are overseas. We say overseas, so they're over the sea, us being Ireland. Yeah, I don't really. I mean, we do have a vibrant scene, but I'm just not massively a part of it. That's all. There is lots of commerce, in Australia. In terms of market, it's very similar to the UK and the US. Like, in terms of e-commerce penetration rate, you're looking at like maybe close, like 15% in 10 to 15% range. So a lot of people have to internationalize pretty quickly as well. So Australia is only like 25 million population. So you really have to think about how you're going to expand outside of Australia. I mean, what's that size of Cali, or like a bit under the size of California? So you really have to think, okay, what markets am I going into? How am I going to internationalize? How am I going to handle, 3PLs internationally? How am I going to handle marketing internationally? And typically it's like, Australians want to crack the US market because that's really where the
Everyone
massive
does, I
scale
think.
comes from. It's you crack the US market, you try and crack UK, and Canada, New Zealand. They're like the big tiers that you try and crack. So yeah, that's a bit of what our market is like, I guess. But it's very we have our own currency as well. For those of you who don't know, the Australian dollar. So please don't think we're on the pound, being being part of the colony, or or the US dollar. We do have our own currency.
Yeah, and you have some pretty stringent speed limits as well. And you've got, like you said, a sparse population. I think kind of peak time in somewhere like Perth, there's about 12 people walking around the streets. So that combination of kind of sparse open areas and speed limits, delivery times, pretty good in Australia, or?
It's definitely not as mature as the US. So like Amazon has really conditioned everyone in the US to expect fast delivery, next day delivery. We don't really have that in Australia due to the spread. It's getting a lot better, but the infrastructure just needs to be built out a bit more. A few days delivery is acceptable. People will accept delivery within same week is acceptable. With supply chain being the issue during COVID, I think it kind of taught people to be a bit more patient as to when they get their products. Some groceries are same day delivery. The grocery networks are pretty built out, but 1 to 2 days delivery is pretty standard, I think. And Amazon just keeps pushing the barrier, right? Amazon keeps investing in the infrastructure, pushing the barrier with what's expected. Means they can get more Prime customers for the service they offer with free delivery, and the flywheel keeps moving. But I think e-com has to work a little bit harder. You having to rely on their third party delivery or whatever is offered in the market of any country.
Yeah, well, it's a real pleasure as well, Tyson, to speak to a fractional CMO because there's not that many of you knocking around. I remember a time where the fractional concept sort of came into the spotlight and everyone was sort of talking about fractional CFOs and but fractional CMO, I think, is a bit harder of a something to convince a founder of, I guess, just because of the nature of marketing and advertising in general. How have you found it being a fractional? And obviously we're going to talk today about some of the value that you have in your back pocket, but how have you found being a fractional CMO?
Yeah, fine. I was introduced to the concept of a fractional CMO in 2015. I used to work in a venture capital firm called Project A Ventures. For those of you who don't know Project A, they're based in Berlin, and they unlike a traditional VC firm, they have where we'd have like 3 or 4 managing directors, and that they give you some money, and they maybe sit on your board and give you some advice. The firm that I was part of, Project A, was quite significantly different. We had like 100-person operational team, everything from business intelligence to performance marketing to HR recruitment, to business development, product, front end dev, back end dev, venture team, etc. So we're basically like a full stack investment firm, and the thesis was that to provide operational expertise would increase portfolio companies' chances of success. When I was there, I was a part of 3, 4, 5 exits, meaning that I worked on companies that then went on to exit while I was there, and then since then maybe another 5 of those companies that I worked on had gone on to be acquired. And so back to the fractional CMO point, I was in the performance marketing team. And so the performance marketing team consisted of your traditional performance marketing team, paid search, Facebook, or like, media buying, CRM, retention, and affiliate marketplaces, and leading the team, and then we have like the different, the juniors, the mid-levels, the seniors, and then the heads of those teams, SEO. And then, of course, you need like a leader of the team, right? And so, of course, that's like the CMO. And so we had the CMO of Project A Ventures sit in the performance marketing team, and they would I guess like contract their CMO services to the different portfolio companies that we would invest in, and we mostly had a bias at the time towards direct to consumer and marketplaces, so e-commerce. The founding managing directors were ex Rocket Internet, so think HelloFresh and Zalando were Rocket Internet. And so at the firm, we did three things. We incubated our own portfolio companies from scratch. So think about like looking around and seeing gaps in the market, having a thesis, and then testing that with some capital, running some experiments, and then if we had some success with whatever the hypothesis and thesis was, we'd go on to like invest some seed round, our own capital into that, the firm's own capital, not my capital, the firm's own capital into that, and then if that goes well, hire a team and just scale it out as you would a normal startup. So that's like the incubation projects. The second part was like seed the Series A rounds, where we'd partner with other VC firms and they'll bring us deals, and then we'd go on to co-invest with them. But also more specifically, which set us apart, we would we would either help them. Now you've got this few $1 million in your Series A. How do you deploy it? What's the media mix that you should be thinking about, depending on the type of business you are. If you're like a marketplace, you're probably a bit more focused on improving demand capture versus really scaling into TV and create awareness at like the Series A level, versus like someone who has an entirely new product, doesn't have any awareness, no one's typing their product into Google. You have to create that awareness somehow. So probably a bit more top of the funnel marketing. So it would help them think through the media mix. If they didn't have any team in place, we would be their team. So we'd go in and actually do the work, and we'd work similar to like an agency does. Where I was at any given time, I was probably working on about 2 or 3 different venture investments, portfolio companies. And the third thing and if they did have a team, we would go in and like kind of help help guide through change management, whereby we would either help upskill the people who are already in the team, and train them and help them get better, and add more as like a head of position for them, and then like maybe retrain them in some of the framework standards that we had and templates, and then we'd like slowly fade out. And then the third thing we did was that similar model, but with private equity firms. So EQT from Sweden, top 10 private equity firm in the world, under funds under management, or AUM. They would buy companies, and one of the companies they bought while I was there was this German auto parts distributor, this online German parts distributor with like a few 100,000 different SKUs. And so they would acquire that firm, and then they'll go, here, Project A, we need you to grow it for us. And so in that place, you already have 100 people in the company, and they're doing a few 100 million euros a year. Then you'd have the senior people go in like the fractional CMO at the time, and then she'd bring the team in, and then would report under her, and she'd work with the exec team there. So that's the long answer of like when I was first introduced to the concept of fractional CMO. It was in 2015 with the venture capital firm I worked for, and it was pretty common in Berlin, where you have like all this massive startup scene, lots of Rocket Inter and Project A investments, lots of fractional CMOs who just were part of that Rocket Internet or Project A ecosystem, and got a ton of experience under the belt. And then I always thought it was an interesting model, because you got to choose who you work with, which I do now, and I only take on like 2 or 3 clients at a time. I don't want to, the mental switching cost for the type of work that we do is pretty intense, I think. So I never want to take on like 5, 10 clients. It's always 2 or 3, really go deep and like provide as much value as I can. And I've been doing that for probably 6 months properly now, that I've actually called it a fractional CMO. We decided to be like, actually, it's a fractional. I think what I'm doing is similar to what my framework or reference was back in 2015. I think that's the same work I'm doing, so I'll just call it that, because I think that's pretty the same. And it's a pretty broad spectrum. So you have like everything from OKRs in the team to like how do you do marketing ops, how do you do like change management, like how do you identify gaps and who are the people we need to hire. So that's why it's not generally like a performance marketing role, because I'm not in the ad accounts. I mean, my background is like in Google Ads and Facebook, but even affiliate. But I'm not like in the accounts making changes. So I don't think it's fair for me to call me like a performance marketing manager or anything like that. I do leadership. I run meetings with the team, help the executive team like arrive at decisions. So I think that the work that I do fits the title.
I imported a bulk import of products into Shopify, and I did not put in the meta fields the created date, and that sent the whole filtering system haywire, because you could no longer filter collections by newest in first or date added to the website, which was a really big problem for this quite large fashion brand. If I didn't have Rewind, that would have been a complete pickle. It would have taken hours, if not days, to sort out, all of the while these products are live and really messing up their merchandising. A mistake by me, absolutely, but fortunately I had the foresight to install Rewind before I made any of these changes, and I was able to just click a button, restore the site back to a previous version just a few minutes before I made that fatal error, and no one was any the wiser. That's the value of Rewind. That's just one use case, okay? One use case. There are hundreds of other use cases. Have it on there, because when you need it, you'll text me or you'll tweet me and say, thank you so much, Finn, for recommending that I installed Rewind. You saved my bacon. Back to today's show. How did you find? I'm really interested to know a bit more about that, Tyson, because straight away when you were talking, one of the things that popped into my head was, if I was one of these founders, how would I feel about another team? Essentially, the psychological aspect of that is, we're better at this than you are, so in we come, and that's got to have some ramifications. But I then thought, well, the flip side of that is they have a choice to choose that VC investment, hopefully. Maybe
Absolutely.
So that I guess you end up with the ones that end up wanting that. Is that the case? Did you end up with that? And if that is the case, do you think the model worked?
Yeah, so I was there from 2014 to October 2016 from memory. And you're exactly right that the type of founders that would come, that would approach Project Day, they would self-select themselves for, I've seen operationally what they're capable of. Like the founder would be like, okay, I know what Project Day are capable of. I'm aware of the team and what they've done. Therefore they would want that expertise. It's more like, I know what they're capable of. I want that. I want my company to, like, my company needs that. I'm going to choose them as a VC to invest. Hopefully they do invest because they like what we see. But they're mostly coming to Project Day because they actually want the expertise that was available. And not only that, like, Project Day didn't have to take on any investments that they didn't want to. We'd see hundreds of investments a year. I'd be getting deals to look at all the time, and helping them order accounts. So companies would unlike maybe it's more common now, but before, like, they would open up their accounts and be like, okay, we're doing some due diligence on this investment. Can you please do a deep dive on their paid search accounts? Look at how it's structured, and what we're looking for is, like, does it have potential for, like, what is the uplift potential for when we would not take over, but for when we would work closely with the team? What is the uplift potential across the board? If things are structured really well, if things are running like really smoothly and at a very high level of execution, then maybe that might not be the best investment for us. Or maybe it's just an awesome team and it's a rocket ship, and we absolutely do want to make that, and we take on more of an advisory role rather than do the work role. So it depends on the stage, if it's a seed stage or Series A. Usually the case is that they have one person. If it's a Series A, usually the case is they have a generalist in the team who's kind of doing everything. And they're like, I'm so busy, I need some help. And so would come in and kind of try to coach them and elevate them to like a senior, like head of performance, or like a senior manager's head of performance, try and coach them. And also, do the work for them in that stage, and then just make sure we're transparent and updating them with everything. But you're right. Some people might be resistant. I probably work with 15 portfolio companies while I was there. Probably one or two might have had some resistance. And so you do. I remember taking part of because we kept encountering some of these things, like some things over time, and so we brought in, like, the firm brought in, like, a change management expert to, like, how do you help people through change management? How do you help companies through change management? Because we never want to be like, oh, we're coming in to like change everything for you. We have to make sure that the incentives are aligned between the operational team in Project A and the founders. So, you pick the right team, first of all, who's, like, open to this. And then you just assure them, like, you're in control. This is your company. Like, or it's actually not kind of like that, because, no one's really in control of the company. The board, is runs the company, and the CEO reports the board. But you get the idea. Like, I guess founders, they're still responsible for day-to-day execution. They're still responsible for the company, and we want to work with your team. The team is usually receptive. Usually the type of people who are working in these projects are people who have, like, a growth mindset, and not like someone who's super closed to learning new things, right? So you typically have the right people in there in the first place. But there is some change management that goes on, and typically the framework is you come in to the company, and whoever is really open to, like, change, you keep, like, elevating them and talking about how they're open to change. And you keep demonstrating that, this is good. And then eventually other people come along who are, like, happy to go through the change management process. And then maybe there might be, like, 10% of people who just aren't happy. And you try and do the right thing by them all the time, and help upskill, but sometimes, unfortunately, it's just, it doesn't work out like most things. And you help them find another company if that's what they choose to do. But we would never pressure. Like, oh, this person needs to go. We always came with the mindset of, we're here to help people, and we're here to grow together and learn together.
I've got, a number of questions, really. One, perhaps a little bit niche, is how do you, because you're against a typical VC, investing quite a lot in these companies from a staff perspective, or the VC overheads are a lot higher, I imagine, than another VC that doesn't have 100 people on staff to deploy into a business. Do you know? How does the VC recuperate those costs? Is it split between?
Happy to talk through that. Happy to talk through that. And everything I'm saying, as far as I'm aware, is transparent knowledge. I'm not disclosing anything that isn't otherwise secret. So the model basically works like this: is the partners take a less management fee for themselves, and because you have AUM. So basically, the VC model works like this. For those aren't familiar, the partners go out and they raise money. They raise a fund, and typically they have a 2 and 20 model, where the partners collect a 2% management fee for the funds that are under management. So if you have 100 million under management, you're collecting 2 million under for the management fee of that fund. And what that is supposed to help with is pay salaries and any other costs that are associated with managing funds. And the 20% is the percentage of profits that you then the partners, the firm, not the partners, because partners have to distribute profits back to their limited partners, that they get. So 2 and 20 is like the model. And so they took of the 2% of the 2 and 20, the partners who are at this firm took a lower amount, and they basically spread it across as much as they could. It didn't cover everything, but they spread it across as much as they can. And then the other part is, like an agency, we just bill out people. but we'd bill them out at cost. We weren't like a for-profit services firm. We were a bill people out at cost, and the firm only made money when companies were acquired, or exited. That might be via IPO. From my understanding, none of the firm's investments have IPO'd. However, lots have been acquired, even to Shopify. Ticktail, I think, was acquired by Shopify as well. So yeah, I've been using Shopify since like 2015 as well, 2016. Some of our portfolio companies were on Shopify to begin with. So does that answer your question?
Yeah, 100%. I think so. I just was really interested to see, where their priorities were in terms of covering that cost. But
exiting. And that's why the incentives are aligned a bit better than an agency, for example. Agency model is, for the most part, it's definitely evolved a lot over time, but keep it simple. It's like you sell services and you try and profit the difference between selling the service and the cost it is to to your business to like have the service, so staff, rent, etc. And then the agency owner makes the profit. So that's perfectly fine business model. And whereas Project A is they only make money on the exit of their investment. And so obviously you want to, there are things that you might do that with that model that might structure accounts differently than you would as an agency. I'll give you some examples. So as an agency, your model is probably to, I don't want to come across like an agency bashing. I've worked with plenty of good ones, but I just want to talk through the difference of the model, and I think how it just aligns a bit better. Is the agency model is I guess maybe you want to make as much money per account manager. So if you have like a Facebook ads account manager, maybe they have 5 or 10 accounts underneath you, or whatever that amount is. And so maybe as a result of that, maximizing like account management per person, or I don't even know what the metric is, would be like accounts managed per person, or like dollar profit per service per person, something like that, I would assume. Maybe as a result of that, you structure your accounts in a way that requires less of a touch point, because you want to manage the most amount of people, most amount of clients, to say. And so you want to, I guess, do things that require less attention, like a healthy balance with like less attention versus like good outcome. But it's a sliding scale, right? And so in the firm, we would do things that just gave the best outcome, because maybe I'm just working on one project at the moment, or maybe I'm working on 2 to 3, 2 small ones and one really big one. And I'm working like 50, 60 hours a week. So I'm not aware of any agencies that are one person is working on one account, or like one person working on 2 small ones and a big one. So that's one of the primary difference. And an example of that is like, I remember when I was there, I remember working on this one of our portfolio investments called World Remit. It's an international money transfer company, competes with TransferWise. And we were managing between 4 of our team members in paid search. We were managing like 30 million keywords. 30 million. Now, how is that done? Well, you have one account per country, and we had something like 50 countries. So that's how, and to do that required 4 people. Now that's 4 people. That's like 4 people working on just that one account. And I remember we worked on that for about 6 months. And so, and then went through a massive growth phase while we're doing that. And that's just the example, I think, of where like we're managing that account at break even for the cost of 4 people. The cost was break even, and we're only trying to we're doing as best as we can to like make everything as efficient as we can across 50 ad accounts. 30 ad accounts across 50 countries, 30 million keywords. And the only way you can possibly really do that is if you really have your incentives aligned, I think from like what the exit outcome is and making a profit that way versus trying to maximize efficiency in the number of accounts that one person might manage. Does that make sense?
Yeah. And I think it's aligned. If I was the founder, I would be even more inclined to accept the help of this team because of the fact that they're safeguarding their own investment. And therefore,
exactly. Yeah, exactly.
Your mentality going into it is, I think a lot of the time with agencies, there is always that seed inside you that knows that they are a for-profit business. And therefore, there are going to be occasions where it would be better for you to have someone internally but on the whole, you hope that the skills they have over time and the exposure that they have nets out in your favor versus an employment. But I think with that model, you've got a lot more going for you in the fact that, they've vested money here as well. And they've put the people they believe are the best to protect that investment.
Exactly. And has to, they take the firm took a board seat as well. So they always have their interest there. But we would always try and in-house people as much as we could too, because we didn't want to be a service provider forever. Like we know you have to, you crawl, you walk, then you run. Maybe we would help them transition from like walk to run, and then we would. So that example is a good example. So we're 4 of us managing 30 million keywords across 50 countries, and we then got them. We built that all out and the structure, and we got it running smoothly. And then we'd be like, all right, well now we want to hire people to like maintain what we've built. And so then we'd go and hire and bring people in, train them, fly them over to Berlin from London, train them, and then like fade out and then move on to something else. So we like fire ourselves in that regard. We'd be like, okay, the next step for you is to like hire people internally who can do this as well as we can, if not better, because you live and breathe the business. You're in the company. You understand the nuances a bit better. And then we fire ourselves basically, and then we move on to like another investment. So we always had the best interest of the portfolio company at heart.
You are in the DTC space. If you have a brand that's selling online and you haven't at least had a demo with SendLane, then one of 2 things is objectively true about you. You like setting money on fire. You like making your life more difficult. If neither of those things are true, and you are an e-commerce brand and you are selling online, you do send emails, you do send SMS, you do have reviews, or at least like to collect reviews, then there is no reason for you not to at least have had a demonstration with SendLane. They are built for e-commerce. They are the most modern platform with the best features, in my opinion, at the lowest cost. I mean, I'm not really sure what would be holding you back. Please go and check them out. Show notes below. They have an event coming up. You can still get tickets, I believe, for that event in San Diego. A link to the Commerce Roundtable in the show notes below as well. Please do go and check out SendLane if you haven't already. Back to the episode. Here's one for you. I've been a little bit exposed to VCs. I worked with a VC for a little while. I've pitched VCs as an agency, trying to work with VCs back in another life on their portfolio companies. And the overriding impression for me is that it is a very data-centric environment. Absolutely understand why that would be the case. But it sounds to me like you've got the worst of both worlds as a CMO, because you've got a founder that didn't employ you themselves, or a business that didn't choose you before the investment. And then you've got the VC who is, my assumption, adverse to risk and consistently looking for you to be able to justify almost everything that you do with a level of depth that is beyond gut feeling, which is often where a founder gets to that place where they're going to need some investment. Is they need, part of what we're going to talk about today is bringing in structure. So how did you feel operating as a fractional CMO in those environments? Was it heavily data driven? Were you having to justify every move you made? And then ultimately, did that make you a less risky or a more risk averse marketer?
Yeah, so just to be clear, I wasn't a fractional CMO in that environment.
Right.
I was in the paid search team. I was like a senior paid search marketer, so paid search, Google Ads basically. But we had a CMO in the team, and she would be a fractional CMO to our portfolio companies, and so I reported into her, and she would. But to your point, so I'm only now a fractional CMO, and I learned about the concept of fractional CMO through the venture capital firm that I was with. But to your question, we had a business intelligence team. We had an entire department at this VC firm dedicated to data analytics, and this is before companies like it's a lot easier now than it was back then. This is before your Triple Whales and your North Beams existed, where you can just like plug in your Shopify, connect your Shopify, connect your Facebook and Google accounts, and represents data in like a pretty good way. Like that would have been great back then. We didn't have any of that, and those platforms didn't exist. So the team there had to build out their own business intelligence competencies, and so they would build out. So part of the investment would be, how do you allocate some of this capital? Well, we would recommend, how to do the marketing split for Facebook and Google, and what percent of marketing, etc., dependent on the type of investment or industry you are. But also mostly, and by mostly I mean not all the time. We would ask. We had to like pitch why we thought this was a good idea for them to have like business intelligence infrastructure. And so the Project Aid has an internal business intelligence team. They would like take their BI internal dashboards that they had built, and they would like port over and develop it for our portfolio investments. And that's actually where my scorecard framework comes from. It doesn't come exactly from them because it's structured very differently. The type of data I use is different, but the concept and like the framework of having like this core dashboard, an infrastructure dashboard that is customizable and visualizes the data in a certain way, actually comes from the business intelligence team that I work with at Project A. So an example would be, I had part of my OKRs when I was at Project A. Sometimes is we want to automate we're mostly using Excel spreadsheets. And so we had to get really good at Excel. We have like the BI team send daily updates on this massive spreadsheet with like multiple amounts of tabs. Reporting wasn't as easy back then. The data infrastructure just wasn't as good back then with like even Shopify or we had our own infrastructure, e-commerce infrastructure that we used as well. So just the data structure and the reporting just wasn't as like polished as it is now, and as easy to use. So part of my OKRs for several cycles with this VC firm was, okay, well, we want you to automate how we do our Google Ads reporting for one of our portfolio companies or 2 or 3 of our portfolio companies. Work with the BI team to do that, etc. And so I would work very close with the BI team to integrate the data that I was using and the frameworks that I'd work with and help develop, and integrate that into their custom reporting. And then we had these templates that we'd use, and we just recycle the templates over and over for these new portfolio companies that we invested in. And they'll get better, and they get a little bit better, and they get a little bit better, and they get a little bit better. And then that's kind of what I've been working on for almost 10 years now to like get to this dashboard that you saw on Twitter was like that. So this dashboard is like the evolution of me doing this for almost 10 years, like this dashboard concept, almost 10 years.
I think someone retweeted it at the time, and I saw it, and it flashed. And whenever I see a tweet like that, when someone's broken something down, you can instantly tell when it's good quality. And I clicked into it, and I was hooked on that the first part of the thread. And I was like, man, I don't think I've ever seen anything like this before. Not data presented visually in a way like this. I'm used to seeing the dashboards, But what I found really, really intriguing was also how you were looking at it across the whole purchase journey and how you were bringing lots of different components of data together that gave you a bit more of a vision. So this is a really good time. And if you've tuned into this episode, that was almost 40 minutes of an introduction to Tyson, but I think needed because to understand
let's talk about the dashboard.
but to understand where it came from, where this has all been derived from, and get an understanding of the background, the environment, I think is really important and just adds to it in any case. So now we're going to move over and we're going to transition. So if you're only listening to this podcast, I would advise you probably to take a pause at this point, because Tyson is going to share the scorecard on his screen and we're going to talk through it. And I'm going to play the role of a variance of different founders and operators in DTC and ask some questions, hopefully that will get you the answers you want. But ultimately, we're just going to have a little tour through this incredible scorecard. So Tyson, just give us a quick explainer as to why a DTC company or a commerce company might want to utilize something similar to this.
Yeah. Can you see my dashboard?
Yeah, we can see it. We can see it.
Wonderful. So there's a few reasons, and this has gone through like lots of iterations over the years, but I think I've come to a point where it really brings first of all it really brings a lot of transparency to for the business and to the team. And so a lot of the time, the team operates in its own silos. So you have Facebook or media buyer team that they're looking at, they're looking in platform. Maybe they're a bit more sophisticated. They might have some attribution tool or some media mix modeling. But in general, they're spending probably like 80 to 90% of their time in platform. And so they're not really looking at other metrics like contribution margin. Usually they're not looking at other metrics like that. Maybe they're a bit more sophisticated. Or maybe have the creative director who or creative strategist who is creating lots of ads and doesn't really see the business impact that those ads have when they're launched or new campaigns are launched. Maybe have your email marketers in the same position as a media buyer that they're living in their email platform, and they're not really seeing what's happening across the entire business. How do questions start arrive like, how did we go yesterday? How did what was the profit yesterday? Did we meet target? So all these questions start to arise, and it can take the form of like waiting for like a weekly meeting to happen, which in my view is like too slow of a feedback loop, or it could take the form in worst cases monthly. If the team is only made transparent how the business is doing every time the P&L comes out, even if they're part of those meetings at all. So what one of the main aim of the dashboards is to do is to bring business transparency to the team, so everyone can see how many sessions there are, what was the conversion rate, how many orders, what's the AOV, what was the average quantity of items purchased, what's a new customer percentage of new customer net sales to returning customer net sales. Every time do we send an email, does the percentage of returning customer net sales increase? And if so, well, there's probably the emails are probably incremental, and there's other ways to look at that as well. What's the MER? Are we on target? Are we within the range that we want to be at? What's the discount? Are we discounting too heavily? Is 5% where we want to be at?
Just give us a step-by-step through why you chose. So I can see the dashboard, and in the lighter grey along the top, the axis there, you've got the different column names. Can you just walk us through each one and why that you've chosen to include those specifically in the dash?
Sure. So I'll start from the bottom here. It's the most relevant because it's the current week. So here we've got current week, and I define current week by Monday. So you got the day Monday, the date's November 27th. This is in Australian time, so just take that into consideration. And 2023, the year. So Monday, Tuesday, Wednesday. So it's Thursday. So imagine you as a part of a marketing team, or even the founder of a business. You want to know, how did you go yesterday? So you log into this dashboard and you go, okay, this is how we went today. And what do I mean by how we went today? So it starts off as like a funnel, right? Because metrics in isolation aren't really that useful. What was our conversion rate yesterday? Okay, it was this, but what does that mean? Is that good or bad? What was our MER yesterday? Okay, it was this number, but is that good or bad? And so you never want to look at metrics, and this is the other thing this dashboard does, is you never want to look at metrics in isolation. You want to look at metric. You want to look at the relationship between metrics, and this allows you to be able to diagnose issues or unlock insights as well. So this is a funnel, okay? So like most things in e-commerce, it's a funnel. So let's go through the columns one by one as a funnel. So sessions, people come to your website as a first touch point. Maybe they add something to the cart. And so you look at the add to cart and you go, okay, so what percentage of sessions are add to cart? And you can see here every day you have your add to cart percentage. And you have the next one, after someone hopefully adds something to the cart, they check out. So you have the checkout percentage as a percentage of sessions. So the number of checkouts as a percentage of sessions. And then, you have your conversion rate. So that's all pretty self-explanatory. So someone comes to your website, they add something to their cart, they check out, and then what was the percentage of people who successfully checked out? So that's pretty self-explanatory. But straight away, what this allows you to do is, let's say, for example, you made a change on your website to the your product PDP, product description page, and it really impacted your add to cart, either a positive way or a negative way. Positively, you'll see that the add to cart percentage is increased. Great, that must be that must have been a positive change. Now, obviously you would use some A/B testing software to properly determine that, but you should be able to see it through this metrics as well. But let's say you don't have any A/B testing software, and maybe you made a change to your product description page, and your add to cart massively drops from 6% to 4%. So straight away next day you'll be able to see that drop, and you'll be like, what's going on here? How come the add to cart hasn't dropped? You can check with the media buyers. Are we scaling? Did we change our traffic source? Do we have something out of stock? No. Okay, so you can diagnose things really quickly and go, it was actually that change that we made the other day that dropped the add to cart rate. Okay, let's look at why the drop changed. The button doesn't work, or on mobile it doesn't even show the button above the fold or wherever it's meant to be. So straight away you can diagnose issues really quickly. Same with the checkout, you can diagnose really quickly. And then we have here, after conversion rate, you have orders, pretty self-explanatory, the number of orders that people made. What was the average value per order? And then per day, average quantity. So this is just basically how many, what was the total, or what was the net number of items per cart? And this usually stays pretty consistent unless there's a big discount. When there's an incentive to purchase more, it stays pretty consistent. And then you have here new customer percentage of net sales versus returning customer percentage of net sales. And this is really important to monitor because maybe you always want to have a bias to acquiring new customers, because if you don't, you will just, and if you don't have good retention, in this case 10% returning customer is not great in this example data set. So you're probably not stacking the cohorts pretty efficiently here. So you really need this new customer percentage of net sales to continue to grow. And if it starts to maintain high, and if it starts to drop, it also gives a signal of okay, maybe you're spending more money on retargeting campaigns than prospecting campaigns. So it's a bit of a barometer on that. Or if it changes, okay, do we send the email? Okay, that's why we had a massive spike in new customer. Returning customers versus the drop in new customer. So it's just a health check to check that, we are growing new customer net sales. And why I like to view it as a percentage and not a number is because if you just view it as a number, it's hard to tell. It's just hard. We have an issue calculating percentages in our head over big numbers. Like, for example, this number 103,000. Okay, what's 89.5% of 103,000. I don't know off the top of my head. Maybe you're better at math than me. But so I just like to view it as a percentage of total rather than the numbers to see are we just acquiring new customer percentage? What is the net sales percentage of new customer revenue? And are we tracking good?
All right, that's the end of part 1 with Tyson. Coming up in part 2, we get into the weeds of this scorecard. We break down all of the metrics. I challenge him on some of those metrics and I ask him to justify why some of them exist and why people should make decisions in the way they do using this type of data. So all of that is coming up in part 2. Special thanks to Rewind and special thanks to SendLane for sponsoring the show. See you in part 2 next week.